just the two of us today. But nonetheless, we are rocking and are rolling. So let's get into it. Let me just remember to press mute on the YouTube, otherwise we'll have some horrible feedback. And we are live. Right, let's do it. So welcome one, welcome all. We've got just a small group of people. I think the emails didn't go out, but nonetheless, if you're watching this on the replay, hello. If you're watching this live, hello, hello. So swing trading, if you're looking for information about swing trading the markets, then we're going to go through one of my favorite strategies, my most consistent strategy. I am of the view that trading should be simple and it should work, and not just for me, for everyone else as well. You know my view on this. So the general theme of today's session is stop buying every dip and start finding a dip worth buying. It seems such a simple thing to state, but most people make the mistake of buying every possible dip in the markets. And as we already know, not every dip is worth buying, to essentially coin a phrase. So what we want to start doing is we want to start finding a dip that is worth buying and not just buy every dip. Again, if you think about it, if every dip was worth buying, well, do I really need to finish that statement? It's not working or not going to work on every instance. And a simple little definition of just adding the qualifier of the trend helps keep you on the right side of an actual dip that could be worth buying. So I'm going to go through my number one money-making pattern in just a moment. But for everyone who's just coming in the dribs and drabs, if you are looking to profit from daily swings or weekly or monthly swings in the markets, then you're in the right place. As I've already mentioned, I am of the view that trading should be simple and it should work, not just for me, but for you. What I want to do is make my process replicatable for each and every one of you, because one of the things that I certainly experienced early on in my own career when I was trying to find my own path for trading is that while it works for other people, or a strategy works for other people, or a pattern or a setup or a tool or whatever the widget and whiz bang that you're using, it wasn't always easily replicatable. So that was what I wanted to do for my own trading. How can I replicate yesterday's trade today, tomorrow, next week, next month? As a byproduct of that, it also means that you can tap into that repeatability of the process. So in just a moment, I'm going to outline, as mentioned, my number one money-making pattern. But actually, we're going to go through two. And when you see number one, you'll know what number two is pretty quickly. And it's a simple process of not just buying any dip, but finding a dip worth buying, because again, BTFD doesn't mean what everyone think it means. So that's what we're going to go through. Today, we're going to explain and apply some layers and definitions so that we can find opportunities in the markets. Now, if you, as a random sidebar, that is just a squirrel thought that's come into my head, when you do this, you also have the opportunity to find counter trend trading opportunities, because, and I mention it because there is the possibility of what we would classify as a counter trend trading opportunity. So we can have a little look at that as well today. Again, my philosophy revolves around being able to give you the right tools, the rules, the software to assist you to be a community, which is what we do here on Fridays and in the private member community every week. And if you'll allow me, I will be a mentor to show you the way. I am the type of person that likes to stop tourists to see if they need directions. It's in my nature. I enjoy doing it, and I get a buzz off trying to give as much back to the community as possible, whether we're officially working together or not. My number one objective is to do this in the fastest and smartest possible way. I don't want to be sat here for long hours flicking through chart after chart like a mindless zombie, hoping that the next one is the one and that I don't miss anything. So if you ever ask yourself a question or the question of where's the trade, we don't want to be, doing the stock market equivalent of where's Wally. We want to move away from questions. We can use questions to assist us, but we don't want to ever be saying where's the trade. When we look at a chart, we want to be able to make a confident, firm statement. There's the trade right there. And this is what rules allow me to do. This is what a process, a systematic approach that finds, filter, and sorts opportunities, that allows us to manage opportunities, and essentially is an algorithm, which is just a fancy way of saying if this, then that, but an algorithm that allows us to take the the guesswork out of trading so that we can make statements. This has happened. I will take this action. And again, as a result of all of this, we come, fast forward almost 29 years now. We now have a family of strategies that are all related to the same thing. Again, I refer to what I do as production line trading. Hello, Asande, is that right? Hopefully I'm pronouncing your name right. I apologize if I'm not. But good morning. Again, we've got one or two people just coming in to the room. Again, a little bit of a late start today for some reason. The emails didn't go out on time. But nonetheless, we're all here now, which is all that matters. So the strategy process, again, the classic trend is what I'm going to explain to you. It's usually the focus that we have on the Fridays. Using the daily charts, it means that we can capture ideally the main move of the month or the main move of the quarter. And it's low maintenance. We should be able to do this in 20 to 30 minutes, 2 or 3 times a week at any time of the day that's convenient. We don't necessarily even need the markets to be open. We also have a short-term swing trading version. This uses the 60-minute chart. So if you have a little bit of extra time to look at things through the day, again, it should take 5 or 10 minutes, 2 or 3 times a day. And most of that time is just checking in. Has the condition, has the rule happened, or has the rule condition been met? If yes, pop the trade on. If no, come back later or tomorrow. Again, it doesn't take that long to actually apply this process, even though you are looking at intraday charts. We also have the newest edition. This is the newest addition to the strategy family, but it's actually one of the first strategies that I started trading. From the algorithms point of view, we've been able to codify it, put it through the rule process and the structure that I prefer to use these days. But this is, again, essentially the same process that actually started when I was full-time trading on index futures, trading the IBEX and Forex currencies all those years ago, back in 2001. Again, these days I like to apply it on the S&P futures. The idea is to capture the main move of the day. And again, we can also do the same thing if you fancy a little bit of day trading. I don't do this much of it. I like to think of it as the cherry on the top. If I'm at the desk and I happen to have an opportunity, then I will take it. But I tend to pick up the short-term, this really short-term stuff with the S&P strategy now, and don't do much of the day trading of the stocks. Again, the idea is to catch the main move of the morning. You can start to see the theme with the way that I view things. We also have range trading patterns and opportunities. So if the market's non-trending, we should be able to capture some range trading opportunities. So that's it. That's the show and tell part of the show today. Again, I just want to remind everyone that there is a brand new podcast. We are on episode number 11. I will be releasing number 12 today. So if you can help me spread the words, just search AntiVestor in your favorite podcast player, or you should be able to find it if you search swing trading as well. Again, I cleverly titled podcast. So if you'd like to download, they're all short form, 5 to 7 minutes long, just to keep you abreast of what's going on in the markets. So that said, let's jump to, again, I think everyone, just casting my eyes down, and I think everyone knows who I am today. I don't see any new people here today, so we'll just skip the usual who am I. I think I've got to do the disclaimer part though. I am not a Wall Street guru. You may gather that, for all the long-term members. I've got to say this part, legally obliged to say that past performance is no guarantee of future performance. We're a responsible adults. It's your money, not my money. Don't be a dickhead. All that sort of the good stuff. What I can demonstrate is that the past performance, the past behavior of price activity, it does sing from the same song sheets. We can look at history to kind of have an expectation of what may happen in the future, but legally there is no guarantee of it. Again, I've got to say that part, folks. I'm sure you can appreciate it. All right, let's before we get into the charts, I've got to admit, a lot of positions that have been closed and tied up. So Wednesday, Thursday, I actually closed several trades. I'm going to start off the losers. So one of the benefits of using the trading strategy that I use stock options as an alternative to trading stock. And this is one of the huge benefits of the way that I prefer to use this. Again, stock as an alternative. So as you can see here, let me just get my little drawing widgets. There we go. So the entry is, let me just get the color change. There we go. So the entry is just about there. And as you can see, it went against me almost immediately. Now, because I'm using an option, my risk is fixed on entry to the full price of the premium. So for example, if the option costs $500 for the contract, so $5 per share, one of them would be $500, just giving you an example. It doesn't matter how far against me that it goes. It's fixed. And this is one of the benefits of doing it this way. It also means that I get to roll the dice on managing it more successfully. So eventually it came back, and this is, you'll hear me phrase, I'll always be early to the trade, but I'll never be late to the party. This particular one, this allowed me to manage the trade more effectively. You can see the broker statement on the screen there, just to show that I'm not Billy bullshitting. But ultimately, it's a trade entry. It was not a great trade, but it was successfully managed to, a small loss in the markets. Again, similarly, we have, let's just get that tidied up. There we go. Similarly, MU was the same. Again, this was a stock that was underperforming. It went against me. It just took too long. But as it did move favorable, I get to close the trade. And this is, again, just highlighting the benefits, or one of the advantages of using an option instead of stock. Stock's going to be stopped out. It's when you're wrong, you're wrong. You're always going to be wrong. The stop loss is going to be hit. The trade's going to be closed. You've appreciated the loss. Now, it may still happen with the option, but I've got all the way until expiration to do something about it, to manage it more effectively. So from time to time, and several times, I get to manage the trade more successfully. And some of them turn out to be profitable trades. Again, here's another one. This is Win Resorts. We spoke about this on one of our Friday sessions, several times, in fact. And you can see the entry quite clearly here. Oops, daisy. That one, and I want to press the right buttons. There we go. Press them. Oh, done it again. Where's my drawing widget? Bear with me. There we go. Right. So there's the entry right there. And almost immediately it went to effectively maximum loss. You can't lose anymore. It could carry on going up. But as it turned out, within 2 days, it's turned back around again, not looking gift horse in the mouth. 47 days in trade, we get to close that for, in this case, a small profit. So net across 3 trades that were underperformers, traditionally you would have been stopped out. But now, just by moving from stock to stock option, which is also more capital efficient, means you can have a portfolio of stocks. And then if they are underperforming and the market just yo-yos back and forth, which it has been for the last several weeks, then it just gives you this opportunity to manage those trades more effectively. So this is what we've got. And this is just, again, some of the benefits of that. The rest are profitable trades. They've also timed out, but been profitable. Skyworks, 93% return on capital. So almost a doubler. If I'd been a little bit quicker on the trigger finger, I may have been able to get the 100%, but there we go. Can't have it every time. ZCS, this is actually another one that was underperforming and just moved favorably. So 57% return on capital. MCO, again, another max loss to, small gain. So again, you can't look these gift horses in the mouth. From time to time, you are going to miss time entries. But again, hopefully I'm just highlighting the advantages of using not just a stock option, but use the full price of the premium as this built-in stop loss. And you also have a time exit. So you've got the full measure of time all the way to expiration to do something about it. Again, in this case, this was done, something was done. SLG, 90% return on capital. We have AMD stock, lovely short-term swing trade. AMD, I've got to admit, this was a little bit lucky on the management, just with the way things that rolled out, but 257% return on capital. Normally, if I'd managed this trade strictly and rigidly, I would have had several back-to-back trades on this one. As it was, I got one trade, so it was just from entry to exit. The same net accumulation would have happened. It's just managed to get it in one fell swoop. So there's my show and tell on the trades. Let us go and look at the chart. Let's see if we can find some opportunities to trade. Now, if you've got a stock that you want to review, pop it in the chat box. Again, I can see the Blue Stove. I can see. Hello, Randy. Hello. An interesting name. So we've got the chat box on the Zoom. Pop a little hello, and if you're on not the Zoom, my apologies. Pop a little hello on the, I can't remember the name, YouTube. There we go. So if you're on the Zoom, pop a hello in the Zoom, pop this favorite stock that you want to look at, and we'll take a look at it. If you're watching this live, I can see you all there on YouTube. Pop it in there, and we'll get get a little look at that in just a moment. In fact, let's go and do it right now. Perfect, Brett. So you want to look at the S&P 500. Yes. So we can look at this a few different ways. We can look at it on the cash. We can look at it on the futures. We can look at it on SPY. I like to look at the S&P 500 via S&P futures. Let me just pop the watermark on. I always forget. I don't like it on personally, but nonetheless, the watermark is there. So if you are, again, if you're watching this live, pop a little thumbs up if you like it. If you're watching, if you've just logged in, I can see some of you have. Pop a ticker that you want to review, and we'll review it and see how we can find some opportunities. So, well, absolutely. We'll look at UVXY. That is, that's the VIX. That's one of the VIX ETFs, isn't it? Perfect. That's the. Nevertheless, so the S&P 500. So one of the things that we want to do first, in fact, before we go in there, let's just very quickly review the rules that we like to use. I did promise you the process that I like to use. Let me zoom out. So very quickly, what I'm looking for, I'm not just looking for any dip to buy, or for that matter, any rally to sell. Again, I'm going to go through the dip worth buying. So the first thing I'm looking for is for the again, this is the 200 period moving average, the 50. So I'm looking for the 50 period moving average to be above the 200. As all the regulars will know, there's nothing magical about these tools, these indicators. It just allows me a mechanical framework to say where is price in relation to the tools. And as such, I'm looking for, firstly, the crossover. And at this point, I'm only going to be biased bullish. Conversely, we can see that 200 is there and the 50 is there. So they're stacked the other way. So it means that I'm only going to be looking for bearish opportunities. It gives me this directional bias. And then when price pushes away, you're always going to miss that first push. Keep that in mind. Again, when you've got a trend, you're always going to miss the initial bottom, and you're always going to miss the end of the move. But I think we can all agree that the bit in the middle, there's a big chunk that is very profitable that we can take advantage of. So what we want to do is we want to define the dip, because remember, we said at the top of the hour, I don't want to buy every dip. I want to define, firstly, what a dip is. Hello, Bob. See you on the chat box there. And again, I see 4 or 5 of you watching. Just say hello. It's nice to have a nice audience on the YouTubes. Say hello, pop a ticker in the chat box, pop a thumbs up, leave a comment, and we'll get to it as I'm seeing it on the other monitor. Anyway, so I want to find, I don't want to buy every dip. Every downward movement can be considered a dip. I want to find dip worth buying. So the first part of that is the trend. What is the trend? So when the 50 is above the 200, I'm going to consider that a bullish directional bias. And then when price pushes away from the moving averages, then I know that price is starting to move favorably. So then what I'm interested in is when price comes back to the 50 period moving average. Again, there is the 20, but just for simplicity, I'm just going to focus on the 50. When price comes back to the 50 period moving average, that's going to be my dip. I'm going to qualify that as a dip. I'm going to ignore everything until it gets there. So now it's not just every down movements, because there's lots of, for example, there's lots of down days on this movements, but it's only when it comes back to the 50 that I'm going to say, okay, this is my dip. That's what, so we've got the trend, number 1, and then 2, we've qualified what we're going to call a dip. And then when it pushes back away from the moving average, the 50, then that is my dip worth buying. And we can see that there are multiple occurrences that produce not just any dip, not any downward movements, but firstly, what we've just quantified as a dip worth buying. So the price pulls back into the 50 and pushes away. That's the profitable opportunity. And similarly, on the bearish side, when price pushes away, when it comes back to, in this case, the 20 or the 50, let's add that in now, 20 or the 50, the bit that pushes away is our profitable opportunity. Price rallies back. When it goes back below the 50, that's the bits that we're interested in. That's our profit potential. So very simplistic viewpoints of what the trend is. Again, don't underestimate the simplicity of this. Because quite literally at the click of a button, we can say, well, if I just bought the dip and sold the rally in the way that I've described, without looking at Fed, interest rates, CPI, PPI, RS, all the gubbins of fundamental analysis, if I just be mechanical in my application, let's click a button. If I just bought the dip and sold the rally, then what we end up with is what's known as a positive expectancy strategy. And that's what this is. This is the equity curve over the last 20 years. So there's the date there. So if I just bought the dip and sold the rally on the S&P 500 over the last 20 years, nothing else, without thinking about it, without deviation, without hesitation, so that we've got the repetition, then this is what happens. We have a positive expectancy strategy. Great. What we've just done is we've validated the strategy. That's pretty cool. We've validated the strategy. And that means that we can have trading opportunities. Now, this is the S&P 500. I can also do this on individual stocks, ETFs, Forex futures, 60-minute charts. There's been a request from that from Brett. We can go and look at that. I'm looking for trading opportunities that have, that use this strategy. But then I can also say, is it worth me trading, for example, is it worth me trading Apple with this strategy? Is it worth me trading Pepsi with this strategy? Insert any stock, Baidu, any stock, Amazon, that we want to trade. Is it worth trading these stocks with this particular way of trading, swing trading using the moving averages to find buyable dips and sellable rallies? Is it worth it? Well, at the click of a button, we can say either yay or no. So for example, the opposite to this is, well, let's check out Pepsi. Let's check Pepsi Cola. It's a big multi-cap, multinational, multi-cap, huge dividend player, generally a good company. But is it worth swing trading this particular chart? Well, actually, on average, over many, many decades, it's probably not worth my time and energy, because we've got a generally negative equity curve. So that, again, if I just put $1,000 in on every trade and bought the dip and sold the rise with the way that I've described, it's net negative. It's not a favorable stock for this style of trading. So what I get to do is not just validate the strategy as being a good strategy, but I also get to validate, is it a good strategy for this stock? Is it a good strategy for this time frame? And this is what rules allow us to do. So now we can find the best opportunities on the best stocks at the right moment. Now, the last part to this process is to not look at every stock every day all the time. Remember, we don't want to be zombie trading. We do not want to be zombie trading. Where's my, this is what we're trying to avoid. What we also want to avoid, we want to avoid flicking through chart after chart like a mindless zombie. We don't want to be sat there. We've got a strategy that works, that we've just validated. And then we need to find a group of stocks that are favorable on that stock. So the laborious part of my task is to then go through the stocks that meet my liquidity requirements, capital requirements. I like to trade stocks that have 1 million shares minimum traded on average, and because that means that we've typically got a good liquid markets. I'm not trading penny stocks. I also know that I'm going to trade with options, so I want stocks that have options. And what I can do is I can plug there's about 2,000 stocks that meet those requirements. So the laborious part is, once every year or every other year, I'm going to go through the stocks one at a time. I'm going to plug them through the algo. The good news is you only have to do it once, and you get around about 500 stocks, 600 stocks that are on the US markets that have options, that have at least 1 million shares, that have liquidity, they trade well and behave well for this style of trading. So all I'm going to do is I'm going to take what I consider to be the top 25 stocks, basically the top performers. These are the ones that outperformed the S&P 500 over a 20-year period. So these are what I consider to be the top performers. There's a lot of energy stocks in here. Unsurprisingly, energy seems to be one of those sectors that consistently outperforms the S&P 500. So again, I'm just looking at LNG. LNG has fired off a brand new trade for me. But what we're looking for is when price, let me just get my little drawing widget. It just seems to be glitching for me. I'll just put this over here. Oops, Daisy, what have I done? Bear with me, my drawing widget has just disappeared. Let me just get it back up. So one of the things that we're trying to do is buy the dips and sell the rallies. We've got a strategy that works. We've got a rule set that's been proven and validated. We've tested it on the market, the S&P. And then what I can also do is trade it on, or basically focus my attention on the top 25. Now, my top 25 can be different from your top 25. I'm pretty agnostic. I just wanted to trade the best stocks. But your top 25 might be different. Maybe you want to trade stocks between $30 and $50. That's one of those personal preference things. If you're okay with that, that's cool. Maybe you want to, trade the $10 to $30 range. Maybe you want to trade the 50 to 100. I like $100 stocks personally. It's just that nice balance of, it's got good dollar movements and the options are relatively affordable for me personally. So that is might determine what your top 25 is. So all you can do is you can take that list of 500 stocks, which is available in the members areas for all the members and students that we have here today. It is in the members area. I think I've got I have got a free download as well. So if you're not a member, you can get access to that list as well. Just send me a message and I'll hook you up with it. But essentially, we can find stocks that are suitable for your situation. They all have stocks. They all trade well from the algo's point of view. And I'm going to trade 25 stocks as an absolute bare minimum. And this means that I've now got a portfolio of opportunities. And some of those are going to be bullish. And some of them are going to be bearish. Pressing all the wrong buttons here today, folks. So some of them are going to be bullish and some of them are going to be bearish. And I can see at a glance without looking at the charts, because the way that I've got this coded up is I've got the trend. The trend column here on this custom tool that I've got is saying, is the 50 above or below the 200? If it's above it, it's going to give me a bullish reading, and if it's below it, it's going to give me a bearish reading. So I can see at a glance which stocks I'm biased to the bullish side and which stocks I'm biased to the bearish side. And understandably, we're in a bear market movement at the moment, so there's more stocks on the bearish side of the ledger than the bullish side of the ledger. There's still bullish opportunities, but I'm going to be able to have some bullish exposure, some bearish exposure. Again, under normal circumstances, it's usually an even distribution. It's usually about 60-40, but we're seeing a little bit of an imbalance at the moment, where we've got a very small number of bullish opportunities and we've got a large number of bearish opportunities. Again, we're in a bear market, so it's probably understandable. Nonetheless, if I've got some bullish stocks and some bearish stocks, when the market swings up, the bullish stock should bull and the bearish stock should really accelerate to the downside. That's the logic behind this. So we're completely agnostic to what's going on in the world. We also get to benefit from the exposure to the market as we've just described. Anyway, so where was I? Kind of found myself a little bit rambling. Let me just tidy it up. So the last part, so 3 parts to this, to making this work. Strategy, validate it, have a portfolio of stocks. And the reason why I want 25, minimum of 25, you can have 50, 100, you can have 500 if you want, but at least 25. Because I don't know which trade's going to work. This is the thing that we've got to let go of. I don't know what's going to happen tomorrow any more than the next person. So what I've got to do is I've got to take every setup with the frequency that it sets up when it sets up. Because what I don't know, if I just put the strategy back on, this is the backtesting performance. I don't know which of these trades is going to work. I don't know if there's going to be 2 or 3 that don't. I don't know if there's one that's going to be a huge winner. Like with my AMD trade, I've got a 250-ish% return on capital. I didn't know that that was going to be the one that ran. But I've got to take the trades when they set up, because I'll always be on it when it does happen. And I can't be pissed off of missing it because I decided to second guess the system again. So we've got a system. It works. It's proven. It's time tested. I've been trading this way for many, many decades now. It's only the last couple of years that I've been able to really validate everything that I'm doing, the right stocks, the right opportunities at the right time. But we don't know what's going to happen next. So we've got to take every trade that presents itself as per the algo. So that's why I've got 25 stocks, so that I'm not trading or attempting to trade every stock every day, all of the time, because you're going to go round in circles. You're going to be frustrated. You're going to be pissed off. If you try and do that yourself, then it's not going to be an ideal situation for you, because you're going to just like put a metaphoric shotgun in your mouth and blow your brains out eventually, because you will go crazy. And similarly, you can't jump around from indicator to indicator, from time frame to time frame, from tool to tool, from stock to stock, from market to market, from stocks to currencies, to bonds to futures. Pick one thing, focus on one thing until you see success. So if you want to start with the daily charts, that's great. If you want to start with the 60-minute charts, that's great. So let's come on to Brett's question. The 1 hour chart. So on the S&P future, let's actually go to the my favorites. So we've got AMD top left, Apple bottom left, Amazon top right, and Google bottom right. So we've got trading opportunities. So if I just look at the Amazon trade here, so we already had an Amazon trade here. My apologies, not Amazon, AMD. So we've had the previous trade there. So you've got rallies, price goes below the 50, the algo's fired off a trade there, and you've got this trade that comes back to the 50, pushes away from the 50. That's the profits potential, Brett, that we're talking about. So it does work on the 60-minute charts. Again, at the click of a button, I can validate. Does it work? Not. We know the strategy works, but does it work on AMD? Yes, on the daily. Does it work on the 60-minute charts? So again, you've got price going back to the 50, pushes away. This one, mediocre, pushes up back above the 50, goes below the 50. So these are our profit opportunities when it comes back in between the moving averages. That's our, in this case, rally worth selling. And then as it pushes back below, then this is our profit opportunity. There's our profit opportunity. Oh, I should have maybe used green. There's our profit opportunity right there. As price pushes away, that's the bit of the market that we're trying to capture. Does that make sense, Brett? So does it work on 60-minute charts? Yes, it does. Does it work on specifically on this stock on 60-minute chart? Well, at the click of a button, I can get the strategy performance report up and say, does it work? Well, over, in this case, a 10-year period, and there's hundreds of occurrences. So from pretty much 2017. So there's a bit of time where it was, a little bit janky, a little bit wonky. But from 2017 onwards, we've got a nice steady equity curve. It's on the up and up. So this is a good stock that performs on the daily and the 60-minute charts. I'm going to trade this on the daily and the 60-minute charts. Does that make sense? You happy with that answer, Brett? So yes, it does. And again, I've got the stocks that we use. If you want to send me, Brett, a member in the private Slack community, I can give you some of the stocks and I can expand on anything that's, because I appreciate this is an open session. I'm trying to go through things really fast. And you tend to just get the back of the envelope version. So if you need some more expansion on this, the faster version of the strategy, Brett, just shoot me a message in the private members area. So right now we've got price coming above, there's the 20. So price is above the 20. When it goes back below the 20, then that will be our rally worth selling. There we go. So when it does that, then we can look at selling the rally in the context of a downtrend. Baidu has also just hit its target. So let me get the thing. So my entry is here. Again, the algo is being technically stopped out, as you can see here. The algo would have got you in and stopped out. My entry was there. So I had to sit through a retracement. That's fine. The algo would have got you back in there. So again, another benefit of using options is you're not being stopped out in the traditional sense. Doesn't mean you won't lose money, but you're just not being stopped out in the traditional sense of the word, because I'm not physically using a stop loss. I'm using the full price, the premium, to manage my position. It means that, I can just sit through that retracement. I'm not making any money. My view is when you're wrong, you're always wrong. And you would have taken that loss if you traded with stock. You would have taken the re-entry if you traded with stock, but I've got this all in one trade. So this actually hit its profit target from there to there. But, the entry for us was here, a little bit early. So we've avoided a loss and only taken the profits. So this is just, again, just trying to illustrate another benefit. I would urge everyone to use options. Again, BA, just in the interest of disclosure, there's my entry right there. I like to color code my things. I'm a visual trader, but the algo would have got in, stopped out, would have got in, stopped out. Again, the algo uses stock to track and monitor the performance. But just by smartly moving to a stock option using the full price to premium, I've avoided that loss. Now, this may still be a loss, but I'm already outperforming the algo. Is everyone happy with this? This is, again, just another benefit of using options. I really urge everyone to use stock options, at least consider them. They're not scary in the slightest. If anything, for the reason that I've just mentioned, if you buy just a buyer of option, in this case, buyer of puts, that's the same as selling short. It's a fixed risk trade. The Wall Street would have you believe that its options are scary, options are risky. Well, they're not if you use them sensibly. As a buyer of options, it's the same as selling short. Make sure you've got lots of time on the clock, so you don't have to worry about being right tomorrow. But we get this benefit of, well, this trade's not working, that one right there, but I've also not had to get in and stopped out, in and stopped out. And it may get you in and stop you out 3, 4, 5 times. That's just the nature of a rule-based system, a rule-based strategy. So you're avoiding the losses in this case. So already I'm going to outperform the algo just by moving to a stock option. Doing lots of ancillary benefits. Hopefully are you convinced yet? pop a little comment in the chat box. Are you convinced with options yet? Are you convinced with options? If you're watching this on the Zoom, pop a comment in the Zoom chats. If you're watching this on YouTube, hello, my lovely friends on YouTube. Nice to see some viewers here for a change. Pop a little yes in the chat box, pop a little like and a thumbs up. And if you feel inclined to, share it with someone who needs to hear this message. Right, where were we? Oh yeah, so market, one of the things that I've introduced in the last couple of months was market breadth, which is or market sentiment. And this is hopefully just going to explain why I closed some of my positions earlier there, because we went through some of the trades. Let me just get back to the slides. So if you weren't here at the top of the hour, we went through several trades that were closed just the other day. Let me find my references. Broke statements on all of these. We went through some small losses. So we got Square's a break-even trade for me, ISRG. I forgot to mention that one earlier, actually. Square, ISRG, MU, all break-even trades. We got some small wins on Win, Skyworks, ZTS, Moody's, SLG, and the headliner was AMD. We've got a nice big trade on there. We just went through that on the 60-minute chart. So we've got some great trades going off here. So what gave me the motivation to think about, well, why should I close the trade? Well, firstly, one of the things that I like to look at, this, oops, let me get my drawing widgets. Right, this at the bottom here is the number of stocks on the S&P 500 that are past the 20-period moving average. The number of stocks that are either above or below, the number of stocks that are above or below the 20-period moving average. Ray, I'll come back to that question. Really simple. I'll give you the back of the envelope version, just so you can have something to hopefully go away with and take action on later today. But anyway, this tool here, this is not an oscillator. It's actually a chart. I've put a chart inside a chart just for reference. But this is the number of stocks that are past the 20-period moving average. Now, one of the things that we've noticed is that when they are at extremes, so there's 500 stocks. So when we're between the red lines or the blue lines, we can say that we're at a market extreme. 90% of the stocks are, for example, below the 20-period moving average, or 90% of the stocks are above the 20-period moving average. So when we've seen the market at these extremes, we have seen the market lead to sell-offs or rallies. You know, we have seen this on a regular occurrence when price is at these market extremes. We can see, I'm just correlating the points of the charts. So we've seen price at this extreme here. We saw a little bit of a rally there, but we came back into this extreme reading here. And this is what dictated okay, we're at this market extreme there. So on Wednesday and basically on Wednesday, we were at a market extreme. 80% of the stocks were back below their 20-period moving average. So what I'm using this is as we're at an extreme. We're not, don't mistake my words. We're not oversold. We're not overbought. There's no such thing. But what we can say is we've got a market extreme. And historically, that market extreme, again, I'm just marking off all the times we've been at market extremes. All the times we have been at these market extremes, they have been an indication of around about 5, 6, 7 days, a leading indication that we could be at a turning point. So we were back there again. And this is just dictating, okay, well, I've got an opportunity to take several break-even trades, hoping that they go further is a fool's errand. Some of them weren't at target. Again, they hoping that the underperformers would go further when we're expecting a market rally is a fool's errand. Does that make sense? So this is a really good indication. Again, I've got to admit, we did this together about do you remember, for all the regulars, we did this together about 2 months ago. As a throwaway comment, we said, let's take a look at the number of stocks that are past their 20-period moving average. I didn't think that we had this built into TradeStation, but we do. And again, the ticker is $1.20 DMAASP. You can get this on TradingView if you just search the 20 number of stocks past the 20-period moving average. And again, you'll get this in TradingView, so you can get it for free. It's again just a tool that allows us to say, are we at an extreme of movements? So we've got this market extreme, and this just helped me to time my exits and essentially tidy my portfolio up, take profits where there was profits to be taken. So that was what I did. So what I'd like to see is it get back into this this bullish extreme. I nearly said overbought there. I caught myself saying it. There's bullish extreme movements. And that means that if or when we get here, then between 80 and 90% of the S&P 500 stocks, so 450 stocks, would have gone from below the 20-period moving average to above the 20-period moving average. That's what that means. That's all it is. We are essentially, the market is in a rally. And when or if we get there, that could be a good indication to say, you know what, this rally's over. That's what happened over here. We're not quite there, but certainly here, certainly here, the rally is over. The rally is over. So this is what we can see. It can be a good indication to say, okay, well, this is the rally in a downtrend that we've just looked for. Absolutely, Perry. Yeah, market breadth. It has become a good favorite of mine as well, Perry. So have a great day. I'll catch you later. Enjoy your travels. But yeah, it has become a great favorite for me as well. So it's become a part of my process. Again, it's one of those things when you spot something and you can see these regular patterns in it, you can go back for the last, 2, 3, 4 years, and you'll see this phenomenon time and time again. I'm going to say there's a little bit of subjectivity to it, but all I'm using it for is, okay, just to basically say we are at an extreme, a bullish extreme or a bearish extreme. Maybe now's the time to tidy up the bullish side of the portfolio, take profits, cuts the break-even trades, etc., and maybe start actively looking for bearish trades. So if I'm not already in bearish trades, maybe I can be a little bit more aggressive on the bearish side, or conversely, be a little bit more bullish, be a little bit more aggressive on the bullish side. That is one possibility. Now, when we tie this in with a little bit of chart reading, and I only do the discretionary stuff these days on the markets to get an expectation of what I could do. And this leads into the counter trend trade. So if we're at a market extreme here, and we're expecting a bullish movement, and we've been talking about this for about 2 weeks now, so this shouldn't be a surprise to any of the long-time followers. Expecting a bullish movement, it could be 1, could be 3, could be 5 days, it could be, several weeks like over here. But we're expecting a bullish movement. What I can do is I can look back in history and say, okay, I've got this huge spiky reversal bar. When was the last time we saw spikes at a market extreme? I can look back here. Oh, actually, this is looking very similar to here, where we have this over, catching myself saying it again. I've got to get the habit of saying it. This market extreme, it's not oversold, Phil. It's not oversold. I've been writing this out 100 times. I'll give myself lines like back in school. We are not oversold, but it's a market extreme, a bearish market extreme. And we have the same double bottom with these wicks and big spikes here. We've got the same thing happening now. We've got this double bottom, almost. It's a little bit slightly low, but big spike. We've got this double bottom there, market extreme. What we can do is we can say, okay, well, what may happen next? Well, I can look back to this point of reference in history to say what happened next. Now, this is what I call spot the difference. You'll see this time and time again in the markets where there's a point of reference in history that looks like it's developing in a very similar way. So what can we expect to unfold? Well, we could expect, a 1 to 2 week rally, because that's what happened last time. That would be a fair expectation that, it could happen this time. It could happen again, because history, it sings from the same song sheet. We've seen it time and time again. And if you don't believe me, well, we can look back at the last time we saw a market extreme over on the left-hand side of the chart. We can look at the last time we saw a big spike. We saw a market rally that lasted, 1 to 2 weeks. So it's about 5 days. So, 5-day weeks, 1 to 2 weeks. It went into, from 1 to the second week. Does that make sense? Is everyone happy with that? So you don't have to take my word for it. Look for history. We're expecting a market rally. We've got history to suggest, recent history to suggest, well, you know what? This has happened a few times previously. It may happen again. And guess what? If you don't believe me, let's look at this one here. If you don't believe me, we've got another one here. You don't have to take my word for it. Use your own eyes. Double bottom, bit of a spike in the first peak there. What happened? 2 to 3 weeks rally. There we go. So lovely. We get to have history tell us what may happen next. So there's a high expectation that we could, it's the best we can say, we could see something similar unfold in the future. We could see something similar unfold. Is everyone happy with this logic? Now, what do we do with this information? So let me just pause there, actually, which is code for, I'm going to take a quick drink and make sure that we catch up with the questions. So does this make sense? Is everyone happy with the logic? Look for a point in history that would suggest that the future may unfold in a similar way. So we'll take a look at what to do with this information, and then we'll take a look at the VIX. We had a request to look at the VIX. So we'll do that in just a minute. Fabulous. I'm not seeing any questions that we haven't already addressed. Awesome. Let's get into it. So now the question I left you with was, what do we do with this information? What do we do? Well, if we're expecting a bullish movement, first thing I'm going to do is I'm going to tidy up the bearish side of my portfolio, which is what I did. That's what I showed you earlier. So I've lightened the load on quite a few of my bearish positions that I could manage. And for those of you who don't already know, I only manage profitable or break-even trades. So that's what I've done, tidied my portfolio. The ones that were at max loss, there's no benefit to closing the ones that are just not working for me. I might as well, as I've already said, roll the dice, take it to expiration, because when you're wrong, you're wrong. Closing it early is not going to change that. So I might as well use the full time premium that I've purchased with my option and see if I can manage it more effectively, like Win Resort. So that went from max loss to a small profit. I get this opportunity to do that. So that's the first thing I'm going to do. The second thing I'm going to do is I'm going to see if there's any bullish trades, because maybe I want to be more aggressive on my bullish posturing. So let's go back to the stocks. So my top 25 here, I've got some bullish trades. Let me go back to the daily charts. So some bullish opportunities here. So we've got 4 bullish trades. So I can focus my attention initially on the bullish trades. The first thing I may do is say, have I got some exposure to these already? Because if I'm mechanically trading, I want to be taking the trades as and when they set up. So I can take a look at, let's go through them. So maybe I want to be more adventurous on the bullish trades. If I'm expecting a market rally, I'm going to place the trade anyway, but maybe to take advantage of what I believe will be a bullish market swing that may last for 7 to 10 days, 1 to 2 weeks and possibly up to 3, then maybe I increase my position size. So I'm not going to not place the trade. I'm always going to be placing the bullish trades, but to take advantage of the coming potential bullish swing, maybe I can increase position size on my daily swings. Does that make sense? Everyone happy with the logic? And I'm not placing the trade. I'm already placing these trades, but maybe I can take a second entry. Maybe I can try and compound into an already profitable trade. Maybe I can increase position size. There's lots of things that I can do, but I'm not going to not place the trade, or I am going to place the trade anyway, as I've already mentioned, but maybe I can just be more aggressive on my trading choices. So COP, we looked at this last week. We've got a nice bullish movement here. So is there an opportunity? So again, if I was to add in here, not a sensible place. I'd like to see if I've got a dip worth buying it. Maybe it comes back to the 20-period moving average. Again, it's a bit of a distance away, so there's nothing for me to do there. LNG is a new trade. I've already got a dip worth buying. But maybe I can aggressively add in should price start to move further. Again, I've already taken a brand new trade on this, so again, I don't need to do anything with it. SQM on the sidelines on this one. We've got this dip all the way down to the 200-period moving average, so this doesn't meet our usual criteria. So there's nothing for me to do there. Again, I've got newish trades on those stocks, so there's no opportunity for me to, increase or add in. If I was taking a brand new trade, which I've already done, like on LNG, I've increased my position size to compensate because it was a brand new trade anyway. So I've taken a little bit of elevated risk. MRO is another recent one. We looked at this last week, but we've got this dip worth buying that we've already said. It's a brand new trade. So because it's close to the entry level, and with the new assessment of the market sentiments, I'd be okay with adding to the position here. If I so chose to, then I've got the choice to add in on the bullish market movements, and for the reasons that I've mentioned, the sentiment reasons that I've mentioned there. So I keep scrolling down. Again, we've got bullish market movements on HP. HP is actually a brand new trade opportunity for me. Again, so coming back to the trade choice, we've got this short-term A little bit of a consolidation. It's been going sideways. So just want to acknowledge that. So although the algo has set up an entry there, so I've got the question of like, do I want to be more aggressive on what could be a bullish market movement? Okay, normally I would say, okay, I know the algo has got me entering there, but I just want to acknowledge that this is a little bit of a messy area. Maybe I wait for the breakout, wait for the pullback before I get in. That would be a conservative choice as a manual override. But what I can do is if I've got this bullish market sentiment that I've already said, maybe I take the actual algo entry, acknowledging that it's in the middle of this mess, and call it an aggressive entry. Does that make sense? Everyone happy with that logic of the decision making? I've got two choices. The conservative choice would be to acknowledge that consolidation, wait for the breakout, trade the first pullback in the usual way. Or I can, just acknowledge that, well, I'm expecting hopefully a nice bullish movement over the next 7 to 10 days. I can be perhaps a little bit more aggressive, adventurous, take the trade on in the messy zone and roll the dice on a bullish market movement. That would be how I'd deal with that one. Does that make sense? Everyone happy with that logic there? Cool. Again, if you're watching this on the YouTubes, pop a little thumbs up, pop comments there. All the people, all the lovely people in Zoom already know to leave a comment in the chat box. Any more stocks that you would like me to review? Let's go and take a look at the VIX, which is by request from earlier. Pop the ticker in the comment box, and we'll get to it in just a moment. Yeah, but that's how I'm going to deal with that market sentiment. Indication again by request. We had should we look at the VIX now? From the VIX's point of view, I'm a believer. Promise I won't break into song. I'm a believer. I've got Shrek's voice in my head now. Oh no, was it Donkey out of Shrek, wasn't it? I'm just going to turn off some of the tools that I use here. I'm a believer that VIX can't be traditionally charted. I do believe that VIX is not traditionally charted. So what I've got here is I've got some horizontal lines. And if I just scrunch it out, actually, oh, there we go. I've got some I just want to get rid of, that's the 2020 spike. Let's just get rid of that. So I'm looking at the VIX. This is the Volatility Index. For those of you who don't know, the VIX is basically a measure of option premium. If the option premium gets richer, it usually means that the stock market is selling off. The fear is going higher. And as such, the VIX will have a higher reading and the option premium will increase. This is sometimes referred to as the fear index. And it can be an indication of, is anything funky or weird going on, essentially? So we've had the market selling off, but we've also had the volatility has not been rallying. They have an inverse relationship, meaning that the option premium is not pricing in the market sell-off. That's how we read that. So what we can do when we look at the VIX is I like to think about it as it's the pulse of the markets. That's essentially what it is, the fear index, just to give it its nickname for a moment. But it's the pulse of the markets, but it can't be traditionally charted. And I appreciate, I forget who asked actually, but I forget, you asked for the ETF of this. The ETF is derived from this, just for reference. So that's why I'm looking at this as opposed to one of the ETFs that allows you to trade the VIX. If you want to trade the VIX, you can look at, is it VXX? That's my preference. We're looking at the index, which is VIX, just for reference. And if you want to trade it, you would just go to VXX. Anyway, so where's my drawing widgets? Okay, so one of the things that's, again, just to start from the top again, the VIX cannot, in my view, be traditionally charted. I'm not going to use moving averages. I'm not going to use trend lines. I'm not going to use any of the fancy widgets, the down through, the GAN through, the LO way through, all that nonsense. I'm not going to use any of that. But what I am going to do is just recognize just the levels. So what I've done is I've marked off the 20, 25, 30, 35 levels. Arguably, you could also put, where's my drawing widgets? I'm just going to new parallel. You could also put the 15 on there. Let's do it to 15. So we've got the 15 on there as well. So what it allows me to do is what I can say is if we're in this 15 to, and up to the 25 zone here, that would be normal. The market is probably rallying in an uptrend. which is what we saw again, just to mark it off. There is the beginning of the year right there. And this is where the market was in an uptrend over here, just so you can see that's the stock market was in an uptrend. So the VIX was getting lower and lower and lower because we were at or in an uptrend, which means that the volatility, the fear, is going to get lower and lower and lower. We're going to move into complacency, which is what we saw coming into the end of 2021. Again, this is 2022. So what we see, we're in a bear market, and from about it was about here, wasn't it? About May. This is where we went below the 200-period moving average, if you think about it. So what we're seeing is we've got elevated readings, higher elevated readings in the bear market, and this is normal. So we've got to look at this in context when we look at the VIX. So normal range of movement is moved from the 20 to 25. Let me just change colors so it's obvious. So this normal range of movements has gone from these two blocks here, the 20 to 25 area. Let me see if I can make that stand out a bit more. No, that green. Do we want that? Let's try orange. Bear with me. Oh, that's not. Let's go back to black. That's not clearly not working. Black's better. That's making it stand out. Red on red doesn't work, Phil. So we've gone from normal, and this for the moment is the new normal, because that's the normal range. So we'll see it oscillate between 20 and 25. So as it goes into this 30 area, we're starting to get this elevated concern that the market's going to sell off. And typically when we go into the 35-40 zone, the market's going to be crashing. So as we go up, if we went above 35, that's, for me, in any market condition, the benchmark for, holy shit, something weird is going on. So that's really what we want to be considering. So the fact that we've seen the market sell off, make new year lows. The NASDAQ made, I think, multi-year lows, 2-year lows, just for comparative. But the market, the S&P, made a new year low, but we did not see the option premium, the fear, increase in relation again. We've normally got this inverse relationship. So this is potentially another indication that actually maybe we're going to see a market rally, is what we're seeing here. You know, we didn't see everyone fear the option. No one was buying puts. Option premium didn't increase. So with the sell-off, you would expect the option premium, the VIX, to increase. It didn't. And that might just be, again, some more supporting evidence that we could see a market rally. So what we could see, if the market was to rally, we possibly would see price come down into this zone here. So again, we're just charting the same thing, but in this case, I'm using horizontal levels. And, you know, for me, this is kind of how we can break it up. The VIX is elevated. Is it anything to be concerned about? No. If it went above 35 with the new low for the year, then maybe we would have started to see a Black Friday or a sell-off, or, you know, something, you know, funky and weird happening, as I like to say. Because we didn't, it was probably nothing to be worried about. Does that make sense? It's a little bit abstract from time to time, but again, the VIX is it's observed in a non-standard way. And again, the way I like to break it down is in these levels, you know, 1 to 2 levels, you know, normal, something to worry about, and holy shit, the market's crashing, which is above 40, which is what we've got there. So again, you can look back to history to see when the markets have sold off, made new lows, or retraced to correspond with these levels. So we just need to look at it in context, is what we're talking about. So hopefully that answers your question. Maybe it presents a few more questions, but again, I don't chart it in the traditional way, and it can't be charted in the traditional way. Lastly, then, I promised one or two of you, like the back of the envelope of like what an option is, the one-line version of an option. Again, because options, I appreciate, are maybe new for some of you. If you are new to options, and I would urge everyone to consider and think about them, they are nothing weird, funky, or scary. The best way of thinking about a stock option is that it is a the best way of thinking about it is like a deposit. Sorry, I was trying to multitask there and I completely failed. It's like a deposit. It's not entirely accurate. So if you are familiar with options, I appreciate that it's not accurate. But if you are new, it's a good metaphor for what they are in the financial world. So an example would be, if you went to the car dealer, the example I always give, if you went to a car dealer and you said to the car dealer, I like this car, it's got the right color, the right spec, it's got all the, this exact one that I'm looking at right now, I want that one. not another one. I don't want to wait, but that one. And they're going to say, certainly, Mr. Blogs, leave a 10% deposit and you can have this car at the end of the month. And maybe you go away, you've got to organize finance and whatever else you've got to do, check the insurance and all that stuff. But at the end of the month, you've got an option to buy the car. You don't own the car, but you control the car. The car dealer can't, according to the contract, because that's the deposit, that's the deposit agreement. They can't sell that car to anyone else until after 30 days, the end of the month. And you've got until the end of the month to sort out insurance, finance, make sure it's everything's great, and come up with the goods. So you control the car is the point, but you don't own it. And that's what a deposit, that's what an option is. You reserve 100 shares. For example, I'm going to buy 100 shares of Apple. I don't want to buy 100 shares of Apple today. So I'm going to leave a deposit, an option. So I'm going to buy an option that controls 100 shares of Apple or a multiple thereof. That's going to have a small premium, small deposits. And should the value of the stock go up, the value of the option also goes up proportionally. Now, I don't want to hold the option to expiration. So if the value of the stock goes up, so does the option by a proportional amount. And it means that if it hits the profit target that I like, then I can sell the option back to the market. So if I risk $1,000 and the market moves favorably and I double my money, then I will make 100% return on capital. And this is what I was showing to you before. So when I was looking at AMD, so if I put $1,000 on AMD and I buy, in this case, buy a put, and I will benefit if the stock goes down, which it did, and it went down sufficiently enough for my $1,000 to be, multiplied, and it would be 257.3% return on capital. So, do the math. So that's what we get with options. Now, if you sold short stock or you bought the stock, then that same dollar movement, firstly, you might not be able to control 5 shares compared to you control 100 shares, or you can control 1,000 shares at a significantly lower capital requirement. So benefits here. Similar to, well, I don't own the car, but I control the car for a significantly lower capital requirement, a 10% deposit. If it turned out that Steve McQueen owns the car, or it was someone famous owns that car, then the value of the car goes up. But remember, you control the car with your deposits at the lower price. So you can either take delivery of the car, sell it, and you take delivery of the car at the lower price point, because that's the contractual agreement. Or you can sell the deposit to someone else for a proportional amount, because they're obviously not going to pay the full price. So that someone else can get the car owned by Steve McQueen at a proportional discount. But you've made money on selling the option. Now, this happens in the real world all the time. Ferrari, for example, or Porsche, they will make limited edition cars. They will make 100 cars, and it will be 2 years waiting list, or whatever the waiting list is. So you can put yourself in the queue to buy this for special edition Ferrari or Porsche or Lamborghini or Bugatti or whatever the fancy car is. And you're position number 27 in the queue. Now, someone who decides they want that car might buy your position in the queue because you've got a deposit, an option to buy the car. And currently you're number 27 in the list. And that number 27 in the list has a value. And if you were number 5 in the list, that's going to have a greater value to the person that's number 200 or at the back of the queue. Does this make sense? This is just real world examples of deposits and options. It happens all the time. And all we're doing is the financial market equivalence of trading deposits or options. Again, don't fucking roll your eyes at me if you're familiar with options. I know it's not entirely accurate, but for the new people, it just lays the foundation to, actually, you come across these things all the time is the point. Anyway, this is what we did. And this is why, we can have huge returns on the capital used, because the capital requirement is just that. The deposit paid is the same as the capital requirement. So you got $1,000 in and you make 2,500 back. You've got a 257% return, or 250% return on capital. Bing, bang, bong, very easy to do. It also means that we can trade that portfolio of 25 stocks. Because you're not using huge capital, you can trade the top 25 stocks that we mentioned earlier. You can get the benefits of a portfolio style of approach with small accounts or large accounts for that matter. You can trade a portfolio with tiny accounts effectively, should you choose to. You don't have to trade single options. You can use debit spreads, for example. If you're familiar with those, that's great. If you're not, it's a little bit beyond our session today. Anyway, with that said, I think I'm a little bit over time. You've been very patient with me as I've rambled around the houses. Let's get back on track. We've certainly chased a few squirrels today. I'll get that slide in every week. Now I've got just some quotes. I see a lot of people just like not taking action, not doing anything. I'm a huge fan of the Socratic method. I like asking questions to come to conclusions. It's how I came across the algorithm that I do. I continually ask questions. Has this happened? If yes, take action. If no. But falling down, being stopped out is not failure. Not taking new action is failure. So if you're ready to get going with the trading thing, like don't hold yourself back. There's that old adage of, when was the best time to plant a tree? 20 years ago. The second best time is right now. I don't care whether you follow my process or someone else's process, but just follow a process. And you've got to change what you're doing, because if what you're doing right now isn't working for you, it might not be that it doesn't work at all. So just keep that in mind. You've got to make changes. You've got to make course corrections. In my own journey, one of the things that I did to help with this was to keep a diary or a journal. And on every trade, I would write my before, during, and after thoughts, feelings, and emotions, and not just the trade details, because I was trying to improve not just my trading ability, but my ability to trade. And that's the thing that I was trying to change. It's an internal change. Now, if you need a little bit of help with this, again, you can work with me. It is by invitation. I don't work with everyone because it's not right for everyone. Not everyone is ready to make this work. And that's fine. Life situations do get in the change. But when you are ready to make that shift, then you can work with me. And my objective is for you to press the easy button instead of doing the zombie trading thing that I mentioned earlier and keep flapping around and hoping that the next one is the one and FOMOing yourself from one chart to the next, from the Dow through the GAN through the other way through the indicators. Stop that nonsense. Just pick one thing. I like to profit at the end of the day, the week, and the month. I want to use a systematic approach that is time tested, proven, that I've mentioned to you, that gets not just me results, but it gets my students results. I'm very pleased by the fact that it is replicatable, what I do. And it's not just me saying that, it's my students telling me that they get results. So if you want to be, on the scoreboard here of people who get results, then let's work together. That is my unabashed, unashamed presentation to say, if you want to work with me, you can do it. And if you don't want to, that's fine as well. If you're not sure, I will always point you off in the right direction towards a reputable person. So, don't feel obliged to work with me. I'll always point you in the right direction for what you're looking for. But with that said, thank you very much for your time. Thank you very much for your attention. I just want to acknowledge that, we could always be doing other things. There's other things that we could be doing with our time, our attention. Could be with family, could be loved ones, maybe skiving from the work. It's Friday after all. But I just want to say thank you from the bottom of my heart for making today special. You've been all wonderful. You've been interactive. You've been asking questions. You've been popping comments in the chat box. You've been hitting those thumbs up, which is awesome. It makes what I do more enjoyable. So thank you from the bottom of my heart for deciding to spend just, a little over an hour with me here today. Which is wonderful. If you want to catch up with me in the week, again, please keep in mind I have a brand new podcast. Just search AntiVestor in your favorite podcast player, and that will take you to, the AntiVestor podcast. I've been podcasting with a partner for several years, although technically this is a brand new podcast. Please feel free to sign up on my short form solo show, and I will see you there next time. But that's thankfully all we've got time for. Thank you for deciding to spend your day with me once more. And until next time, have a great time. Remember, put it into action and just do it. Awesome, Ray. Awesome, Ray. Glad you got the back of the envelope version. It's very, don't be put off by them, Ray. In fairness, don't be put off by the options. For all the reasons that we are scared of them, I was scared. I actually started out my journey with options many, many years ago, back in the late 90s. It was one of the first things I was introduced to. I did trade a little bit back then. But for some reason, I just got out the habit of doing them. And then I kind of revisited them back in 2009, 2010. And I was like, I don't know why I shied away from them for so long, because I think I bought into the narrative that Wall Street continually said that, hey, options are scary, they're high risk. And the reality is they're not. If you're always a buyer of the option, then they're fixed risk. It's as risk defined. It's not risk free. It's as risk defined as you can get. And when you think about it, like trading stock is riskier than trading an option because your risk is defined on the entry with the option. You physically can't lose any more than the price of the premium. Anyway, with that said, I think I've rambled enough. Thank you very much for your time and attention. Until the same time next time, have a great weekend. Bye for now.